Ladies and gentlemen, welcome. My name is Jay, and this is the Introduction to Crypto. I'm going to be introducing you to the exciting world of cryptocurrencies and cover the fundamental concepts you need to understand. So, let's get started. So, what exactly is cryptocurrency? At its core, it is a digital or virtual form of currency that uses cryptography for security. Breaking cryptography down, crypt means hidden and graphy means writing. It is the underlying code that protects communication and transactions between a party, ensuring authenticity, confidentiality, and integrity of that transfer. Cryptocurrencies also operate independently of a central bank and are typically decentralized. What is decentralization? Well, it's the process of distributing power away from a central point. No single entity has exclusive control over data or processes, and this includes traditional financial and government systems. So, how is this implemented in crypto? Cryptocurrencies are built on a technology called blockchain, which is a decentralized ledger that records all transactions across a network of computers. This distributed nature of the blockchain ensures transparency and security. The crypto market had seen a surge back in its 2021 bull cycle, hitting a total market cap of $3 trillion. There are thousands of cryptocurrencies out there, but the most well-known one is Bitcoin. Bitcoin was created in 2009 by an anonymous person or group of people using the pseudonym Satoshi Nakamoto. Since then, many other cryptocurrencies, often referred to as altcoins, have emerged, each with its own unique features and purposes. And as you can see here, there are plenty of sectors in the crypto market, such as store value, blockchain, scalability, ISO 20022, DeFi, DEX, so on and so forth, but the ones we're going to focus on right now is blockchain, soon enough. But getting back to the advantages and disadvantages of crypto, major advantages are fast and low-cost transaction fees. Crypto can cut out the middleman of the bank, which drastically reduces fees when transferring money. There are many other advantages that you'll soon see in the course. On the flip side of the coin, there are also disadvantages. It is a fairly new asset class compared to all other major asset classes, so this can be affected with big price fluctuations. It is a riskier asset than most, and if the economy is doing well, then that may entice people with a higher risk appetite to look into crypto, and vice versa if the economy isn't doing as well. It is also battling regulation right now, which can both positively or negatively affect it, and it will require you to stay on top of things to ensure great returns. It may not be as passive at times to just invest and walk away, but ultimately, I view it as a tipping scale between time and money. If you have a lot of money, then you won't need to invest as much time. Simply invest in the Bitcoin and Ethereum, and you're probably good to go for the next couple of years. This is not financial advice, obviously do your own research. But on the other hand, if you don't have as much money, that's okay. You will just need to invest more time into it to make up that difference, thus the tipping scale. I'd like to wrap up this first video with the landscape for the course. As you can see, there are a lot of topics to go over. My goal is to go through as much information assuming one knows nothing about crypto. And after completing the course, you will be armed with newfound knowledge of an emerging asset class. I'll be covering benefits and risks of crypto, how to sign up and use exchanges, the types of wallets and NYK/NYC, not your keys, not your crypto, fundamental concepts of underlying cycles in crypto, popular coins, fundamental and technical analysis, how to build a crypto investment portfolio, and also, which may turn into a future live stream series if people are interested in that, managing those investments, and ultimately protecting yourself because there are scammers everywhere in this industry. And so, with that being said, this will wrap up our introduction to cryptocurrencies. In the next video, we'll dive deeper into the benefits and risk of cryptocurrencies. And remember, crypto has the potential to revolutionize finance, but it's essential to approach them with caution and educate yourself before getting involved. I'll see you in the next video. In this video, we'll take a journey through the brief history of cryptocurrencies. Understanding the origins and key milestones will give us valuable insights into the development of this fascinating field. So, let's get started. The concept of digital currencies can be traced back to the 1980s and 1990s when various attempts were made to create digital cash systems. In October 2008, an anonymous person/group going by Satoshi Nakamoto published a white paper titled Bitcoin, a peer-to-peer electronic cash system, which outlined the principles and workings of Bitcoin. In January 2009, the Bitcoin network was launched, marking the birth of the first decentralized cryptocurrency. It quickly gained attention among tech enthusiasts and those interested in the potential of a digital currency. The underlying technology behind Bitcoin, the blockchain, was a groundbreaking innovation. And I'll also leave a link to the Bitcoin white papers below so that way you can go give it a read. It's about 8 pages, so it's not that long. As Bitcoin gained popularity, it paved the way for the emergence of alternative cryptocurrencies, often referred to as altcoins. In 2011, Litecoin was introduced as one of the earliest altcoins, offering faster transaction confirmation times and a different hashing algorithm. The following years witnessed the creation of numerous altcoins, each with its own unique features and use cases. Ethereum, introduced in 2015, brought the concept of smart contracts to the blockchain, enabling the development of decentralized applications, aka dApps. In 2017, the cryptocurrency market experienced a surge of interest and investment. This period was marked by the initial coin offering, aka the ICO boom, where projects raised funds by issuing their own tokens. However, this boom also attracted fraudulent projects, leading to regulatory scrutiny. Governments and regulatory bodies around the world started to address the challenges posed by cryptocurrencies. Some countries embraced crypto, while others imposed restrictions or developed frameworks to regulate their use. In 2018 and 19, crypto saw its first hard crash, but quickly followed by a correction in 2020 and 2021, where we started to see how diverse crypto could become. New sectors exploded upwards during this time, like DeFi, aka decentralized finance, NFTs, metaverse, and gaming, just to name a few. In recent years, cryptocurrencies have gained increased adoption and recognition. Major companies and institutions have started to accept cryptocurrencies as a form of payment, and institutional investors have entered the market. Furthermore, the concept of central bank digital currencies, aka CBDCs, has gained traction, with several countries exploring the possibility of issuing their own digital currencies. This is not necessarily a good thing. Cryptocurrencies already solve what they are saying CBDCs can achieve. The governments that are wanting this are using CBDCs as a way of positioning themselves into centralized power in the crypto space, and that's a no-no. And with that includes our brief history of cryptocurrencies. From the introduction of Bitcoin to the expansion of altcoins and the regulatory challenges faced, the journey of cryptocurrencies has been eventful and transformative. I'll see you in the next video. In this video, we'll explore the fundamental concepts of blockchain and decentralization. Understanding these concepts is crucial to grasp the underlying principles of cryptocurrencies. So let's dive in. To help you understand what a blockchain is, I need you to imagine a chain of blocks, where each block represents a set of transactions. When a new transaction occurs, it is added to a new block, which is then linked to the previous block in a chronological order, forming a chain, aka blockchain. An easy way of explaining blockchains is looking at things like Apple and Android. They allow developers who have created an application to post in their system with implementations of the App Store for Apple or Google Play Store for Android. But blockchains can go much deeper than that. A closer comparison is something like Windows versus Mac versus Linux, where it's the underlying technology that helps power an ecosystem of applications. One of the key features of blockchain technology is decentralization. Unlike traditional centralized systems such as banks, Where a centralized authority controls and verifies transactions, blockchain operates in a decentralized manner. In a decentralized network, multiple participants, often referred to as nodes, work together to maintain the blockchain. Each node has a copy of the entire blockchain and participates in the verification and validation of transactions. You will soon get tired of this word decentralization, but it's so important to understand how impactful it can be. I'll be explaining the last 2 points in the coming slides, starting with the importance of consensus mechanisms. To ensure agreement among the nodes and maintain the integrity of the blockchain, consensus mechanisms are employed. These mechanisms enable nodes to collectively agree on the state of the blockchain and prevent fraud or malicious activities. There are various consensus mechanisms, such as proof of work and proof of stake, each with its own approach to achieving consensus. These mechanisms play a crucial role in securing the blockchain and preventing double spending. Let's start with proof of work. Imagine a giant ledger that everyone can see. This ledger records all transactions that have ever taken place on a particular cryptocurrency network. In order to add a new transaction to the ledger, a computer must solve a complex mathematical puzzle. The first person to solve the puzzle gets to add the transaction to the ledger and is rewarded with cryptocurrency. This process is called proof of work. In the case of what I put, early bird gets the worm. If you solve the puzzle first, you get rewarded. Proof of work is a way of ensuring that only valid transactions are added to the ledger and that the ledger cannot be tampered with. It is also a way of distributing cryptocurrency rewards to those who help to secure the network. Here's a more detailed explanation of proof of work. In a proof of work system, computers compete to solve a mathematical problem. The first computer to solve the problem gets to add the next block of transactions to the blockchain and is rewarded with cryptocurrency. This process is very energy intensive, which is why proof of work systems are often criticized for their environmental impact. However, proof of work is also very secure because it is so difficult to solve the mathematical problem. It's difficult to tamper with in the blockchain. This makes proof of work systems ideal for storing value and for applications where trust is essential, such as voting systems. Some of the advantages of proof of work is that it is secure. It's very secure because it is difficult to tamper with in the blockchain, like I've said previously. It's also decentralized, which means that they're not controlled by any single entity. And lastly, it's transparent, which means that all transactions on a proof of work system are public. Some disadvantages are energy consumption. It is very energy intensive, which can have a negative impact on the environment. It has trouble scaling. The scalability is bad. It can be difficult to scale, which can limit their adoption. And ultimately, cost. The cost of participating in a proof of work system can be high, which can limit who can participate. There aren't many, if any, proof of work blockchains except for Bitcoin. So if you happen to see the random news events where the government is trying to crack down on Bitcoin miners setting up mining farms in different areas, you will now understand why. Some farms are so big enough to where they can consume so much energy that it can mess up the power grid at times. It's crazy to think about, but this is a real thing, and that is proof of work. Proof of stake is a more energy efficient and scalable alternative to proof of work. It is also more environmental friendly because of that. Some advantages, like I've just stated, is its energy efficiency, way more energy efficient than proof of work because it does not require miners to compete to solve complex mathematical problems. It is also scalable compared to proof of work because it does not require a large number of miners to secure the network. And like I've stated before, it is environmental friendly because it uses less energy than proof of work. But some disadvantages are that it can potentially be centralized, in the sense that if a small number of validators control a large majority of the stake, then that could be a problem. Security can also be a concern with proof of stake, because if a large number of validators are dishonest, then that could be a problem in the overall system. Majority of blockchains offer proof of stake over proof of work, and these can range from, but not limited to, Ethereum, Solana, Avalanche, Cardano, Polkadot, etc. I'll be covering an in-depth guide on the process of staking cryptocurrencies later in the course once we get to the investment side of things. Moving on from consensus mechanisms, blockchain technology provides security through its design. Once a transaction is recorded on the blockchain, it becomes immutable and tamper-resistant. This means that past transactions cannot be altered, providing a high level of security. Additionally, the transparency of the blockchain allows anyone to view and verify transactions. This transparency promotes trust and accountability, as it enables individuals to independently validate the integrity of the system. Gone are the days of human error where companies will require multiple bookkeepers to check over physical logs of transactions. Another important concept enabled by blockchain technology is smart contracts. Smart contracts are self-executing contracts with predefined conditions that are directly written into the code of the blockchain. Smart contracts eliminate the need for intermediaries in certain agreements and enable the automatic execution of transactions when the specified conditions are met. So basically, you don't need that middleman, aka the banks, and that reduces transaction fees greatly. This feature opens up possibilities for various applications beyond just financial transactions. And that wraps up our exploration of the basic concepts of blockchain and decentralization. Understanding these concepts is essential to grasp the transformative potential of cryptocurrencies and blockchain technology. I'll see you in the next one. In this video, we'll explore the fundamental concepts of blockchain and decentralization. Understanding these concepts is crucial to grasp the underlying principles of cryptocurrencies. So let's dive in. To help Welcome back. So I've gone over many of the benefits already with crypto in the previous videos, but in this specific video, we'll explore the risks and challenges that are associated with cryptocurrencies. It's important to understand the potential risk involved. So let's dive in. One of the primary risks associated with cryptocurrencies is their inherent volatility. Cryptocurrency prices can fluctuate significantly within short periods. This volatility can lead to substantial gains, but also substantial losses for investors. It's essential to be aware that investing in cryptocurrencies carries a higher level of risk compared to traditional investments. Investors should be prepared for price fluctuations and consider their risk tolerance before entering the market. Cryptocurrency markets are susceptible to market manipulation, similar to other financial markets. Due to the relatively low liquidity and lack of oversight, market manipulation tactics such as pump and dump schemes can occur. Unfortunately, these schemes are usually targeting the small cap coins that are under $1 billion market caps. For example, some of the meme coins that have recently been gaining popularity in May of 2023, like Pepe Coin, SNEC, and a lot of those other ones. Another significant challenge in the cryptocurrency space is security. While the underlying blockchain technology provides robust security, there are still vulnerabilities at the individual level. Cybercriminals can target cryptocurrency holders and exchanges to steal funds. It's crucial to take necessary precautions to protect your cryptocurrencies. This includes using secure wallets, employing strong passwords, enabling two-factor authentication, and being cautious of phishing schemes, attempts, or scams. Next, the regulatory landscape surrounding cryptocurrencies is evolving and can vary across different jurisdictions. The lack of clear and consistent regulations poses challenges for individuals and businesses operating in the cryptocurrency space. Regulatory actions or changes can impact the value of cryptocurrencies and affect their adoption and use. It's important to stay informed about the regulatory developments in your country and comply with applicable laws. Lastly, it's essential to conduct thorough research and exercise caution when making investment decisions. Beware of suspicious projects and unrealistic promises and rely on reputable sources of information. Unlike traditional financial systems, cryptocurrencies often lack the same level of consumer protection. If funds are lost or stolen, it can be challenging to recover them. Additionally, cryptocurrency transactions are irreversible, so it's crucial to double-check all details before confirming a transaction. It's important to use reputable and secure platforms for transactions and ensure you understand the terms and conditions of any services you use. This may sound scary and overwhelming, but I'll be walking you through all the steps when we get to the exchange section of this course. So catch me in the next video where I'll be going over price volatility in crypto. See you then. Welcome back. So I've gone over many of the benefits already with crypto in the previous videos, but in this specific video, we'll explore the risks and challenges that are associated with cryptocurrency. In this video, we'll delve into the concept of price volatility and its significance in the world of cryptocurrencies. Understanding price volatility is essential for anyone interested in investing or trading cryptocurrencies. So let's get started. Cryptocurrencies are known for that. We'll delve into the concept of price volatility and its significance in the world of cryptocurrencies. Understanding price volatility is essential for anyone interested in investing or trading cryptocurrencies. So let's get started. Cryptocurrencies are known for their high degree of price volatility, meaning their prices can change dramatically within short periods of time, whether up or down. Several factors contribute to this. One of the primary factors is market supply and demand. Some cryptocurrencies have a limited supply, meaning they're deflationary, and thus their value is driven by market demand. So, fluctuations in demand can cause significant price movements. Other factors include market sentiment, like the fear and greed index of consumers in the market, investor speculation. What do hedge funds, venture capitalists, and other big money think about crypto at that time? Regulatory developments, such as the adoption or abolishing of crypto. Technology advancements, whether it's faster, cheaper payments, accessibility, advancements in AI, and much more. Media coverage. What and how are the news and YouTube covering things? Is it in a good or a bad light, like what's happening there? And then macroeconomic events. How do things like inflation, unemployment, debt ceiling deals, bank or exchanges collapsing affect the markets overall? And these factors can create both positive and negative sentiments, leading to buying and selling pressure. I actually want to take the time and go deeper into explaining macroeconomics in a way that will resonate with you more. let's look at the perspective of all major assets compared to crypto. Now, these are rough estimates, but note how much total market capitalization goes into these different assets. So, as you can see on the right, think of all the assets together as a big financial skyscraper. Forex is roughly 2 quadrillion market cap, which is $2,000 trillion, in case people don't know, owns most of this skyscraper. But they were kind enough to give the New York Stock Exchange 2 floors and commodities 1 floor. But what most people don't know is that there's a small abandoned basement at the bottom of the skyscraper, and this is where crypto lies. Crypto's total market cap, which at this time is around $1.1 trillion, is 6 times less than Forex's daily transactions. Bitcoin, as popular as it may seem to be, is often referred to as the digital gold. At a total market cap of around 500 billion, Bitcoin is 26 times smaller than gold at this current time. Gold is about 13 trillion market cap from what I found. People are always trying to say Bitcoin to 1 million. And if Bitcoin would simply reach gold's total market cap, then theoretically, with Bitcoin's limited supply, that would make it a $650,000 coin. But that is a discussion for another time because it has energy consumption problems, and who knows if it ever get there. It is simply the point that it is still so early for crypto adoption, and that brings price volatility because what will negatively affect traditional store value assets like gold will greatly affect crypto store value assets like Bitcoin in the positive or the negative. But getting back to crypto specifically, the impacts of price volatility in cryptocurrencies can be both beneficial and challenging. On the positive side, price volatility offers opportunities for traders to profit from extreme price movements. Additionally, price volatility can attract attention and investment in the cryptocurrency market, which would fuel innovation and growth within the ecosystem. Moreover, price volatility can create a perception of instability, which may deter businesses and individuals from adopting cryptocurrencies as a medium of exchange or store of value. But as a side note, with this in mind, you want to try and find crypto projects that are pioneering a path to bridge the current system that we live in with the new Web3 interface of where we're heading in the future. You want to try and find top tech companies and see which crypto projects they're partnering with, because once these partnerships become active and public, people will be more confident when larger blue chip tech companies are being onboarded and will be more willing to join the markets afterwards, which would obviously increase coins prices and just demand for things, and also total market capitalization in general, because it is a drop in the ocean as of now. But managing price volatility requires careful consideration. For investors and traders, it's important to develop a risk management strategy, set realistic expectations, and diversify your investment portfolios. Only risk what you are willing to lose and nothing more. Additionally, staying informed about market trends, conducting thorough research, and understanding the fundamentals of the cryptocurrencies being invested in can help navigate price volatility. And that concludes our exploration of price volatility in cryptocurrencies. Price volatility is a characteristic of the cryptocurrency market, influenced by various factors and offering both opportunities and challenges for investors and traders. I'll see you in the next one. In this video, we'll delve into the concept of price volatility and its significance in the world of cryptocurrencies. Understanding price volatility is essential for anyone interested in investing or trading cryptocurrencies. So, let's get started. Cryptocurrencies. Welcome back to the course. So, up to this point, we've gone over a broad overview of what crypto is, advantages and disadvantages, and learning about key aspects in this space. But in the next few videos, we'll be diving deeper into crypto, understanding what makes things move, and also start to grasp what could be coming in the future. Here, I'll be explaining the concepts of market capitalization, tokenomics, and price dynamics. Understanding these factors can provide valuable insights into the cryptocurrency market. So let's get started. What is market capitalization? Well, market capitalization refers to the total value of a cryptocurrency. It is calculated by multiplying the current price of a single coin or token by the total supply in circulation. Market capitalization helps gauge the size and relative value of a cryptocurrency within the overall market. In this example, Bitcoin is currently at this stage, which is early of June 2023, at around $26,731 per coin. Currently, their circulating supply is around 19.4 million Bitcoin. If we multiply these two things together, then we get a total market cap of $518.4 billion. You may think there's no real point in calculating this because the site does it for you. While you're technically right, this serves a huge purpose when doing research for future projections on tokens. Understanding how to manipulate the formula and pairing it with crypto projects' previous market dominance, which we'll learn soon, will go a long way in establishing a solid portfolio. Now, let's understand the different market cap categories. Bitcoin and Ethereum are in a tier of their own, while every other coin is technically labeled as an altcoin. There are debates whether or not Ethereum should still be labeled as an altcoin, but it doesn't really matter all that much. And so after Ethereum, we start to group coins together in categories, starting with large caps. Large caps are roughly any coins or any projects around $1 billion all the way up to $100 billion, followed by mid caps, which range from $100 million to about $1 billion. Then we have small caps, which is around $10 to $100 million. And then we have micro caps, anything less than $10 million. So to give some visuals, there are actually a few free reliable resources that I use, which are CoinMarketCap and CoinGecko. They're very similar, they do the same thing, and they allow you to search for specific cryptocurrencies and find their tokenomics, website, the address, and in this case, distinguish which tokens are in what market cap category. And so I'm going to be using CoinMarketCap for this category, and let me show this off to you. So as you can see here, we can see Bitcoin is around 522 billion by itself in its own tier. Then we have Ethereum around 226 billion. And then from there, we can look at our large caps, which I'd said are around $1 to $100 billion. And so that spans all the way up to this point here. Pax Dollar at 42. So the top 40 altcoins are technically in that large cap category. And then following that is the mid cap, which is around 100 million market cap to $1 billion. So starting from Algorand, and then we'll have to go all the way probably to the second page. Yep, as you can see here, we have this coin at about 102 million market cap. So basically the top 200 altcoins falls into that mid cap category. And then from there, as you can see, there's 104 pages and it gets very small and very small. And you can see here at the top on CoinMarketCap, it says there's about 25,506 coins currently at this time. And there's a general consensus that about 95% of all crypto coins will fail. And so it's very important to do your research and understand that when you go under large cap and mid caps, when you go under the top 200, you are adding on your risk exponentially, and you need to be careful with that. And so depending on your risk tolerance, it's safer, like I said, to stay between the top 1 to 200 crypto, but we will discuss a plan of action whenever we get into building our crypto portfolio later in this course. So tokenomics. It is the economic design of a cryptocurrency. All the factors that drive the value of a token, such as supply, demand, the inflation rate, distribution, utility, and accessibility. So speaking more on what I just listed, we have supply, which we just went over, is the total number of tokens in circulation. The limited supply can help increase the value of a token, while an unlimited supply can lead to inflation. Demand is simply the number of people who want to buy it. Demand can be driven by the token's utility, like Ethereum, or just straight up popularity of the project, like Dogecoin. Also, market sentiment can all play a big role into demand as well. Then we have inflation rate. It's the rate at which tokens are created. High inflation rates can decrease the value of a token, and a low inflation rate can help maintain its value or even make that token deflationary. Then we have distribution, how tokens are distributed to users. A fair distribution can help build trust and confidence in a project, while a centralized distribution can raise red flags, which I'll touch on soon. Last but not least, we have accessibility. It's the ease with which users can buy, sell, and use a token. A token that is easy to access is more likely to be successful than a token that is difficult to use. So an easy analogy is, let's say I really want to eat some donuts and there's this amazing shop that just offered a new flavor, but the problem is it's an hour away. Or I could just go get my normal, usual flavor of donuts at my donut shop 5 minutes away from me. What will you choose the majority of the time? Probably the one 5 minutes away from you. Accessibility plays a huge role in not only crypto, but the entire world. So I want to talk about distribution a little bit more because it can go into immense amount of detail and the different ways of distributing tokens. And so firstly, we have the initial coin offering, aka the ICO. And basically this is a fundraising event where a project sells its tokens to the public in exchange for cryptocurrency. ICOs were really popular during its birth in 2017, but have since fallen off because of the number of scams and security concerns. Next, we have initial exchange offering, aka IEO. It's very similar to the ICO, but tokens are first sold to exchanges instead of directly to the public. This is seen as a more secure and reputable way to raise funds and have been gaining a lot of popularity in the recent years. Third, we have the initial DEX offering, the IDO. It's a newer type of token sale that takes place on decentralized exchanges. So it's similar to IEOs, but decentralized exchanges instead of centralized. And that gets rid of some of that control, which may welcome investors who like that, but also there's less regulatory oversight. So it just depends on what you would prefer here. Next, we have airdrops. It's free distribution of tokens to a group of people. Airdrops are often used to promote a new project or to reward loyal users. Next, we have staking, which we'll be going over in detail later in the course. It's the process of locking up tokens in order to earn rewards. It can be used to secure a blockchain network or participate in a decentralized application. And then last but not least, we have bounty programs. Bounty programs are a way to reward users for completing tasks such as spreading awareness about a project or testing a new product. And so the best way to distribute crypto tokens kind of depends on the specific project and its goals. ICOs and IEOs can be a good way to raise a large amount of funding, but they can also be really risky. Airdrops and staking can be a good way to build a community and reward loyal users, but they may not generate enough revenue to support a large project. Bounty programs can be a good way to get feedback on a new product or to spread awareness about a product, but they're not really a reliable source of revenue. And now we arrive at the final topic of the video, which is price dynamics. The price of a cryptocurrency is influenced by the forces of supply and demand. When there is a higher demand for a particular cryptocurrency than its available supply, the price tends to rise. Conversely, if the supply exceeds the demand, the price may decrease. We'll be covering this soon in the charts in the next video very briefly, but supply and demand will be gone over in further detail in the technical analysis section. Tying everything together, market capitalization, tokenomics, and price are interconnected but don't always move with each other. While market cap provides an overall valuation of a cryptocurrency, price reflects the value of a single unit. Changes in market cap can affect price, but other factors such as volume and investor sentiment also play a role. Market capitalization and price dynamics are important concepts to understand in the world of cryptocurrencies. Market cap provides a measure of a cryptocurrency's overall value, while price reflects the value of a single unit. Factors like supply and demand, as well as market conditions, influence price movements greatly. I'll see you in the next video. Welcome back to the crypto series, and in this video we'll delve into the fundamental concept of supply and demand and how it influences the cryptocurrency market. Understanding these dynamics can provide valuable insights for day traders and investors. So let's get started. Also, as a brief reminder, supply refers to the amount of a particular cryptocurrency available in the market, while demand represents the desire of buyers to acquire that cryptocurrency. So starting off with supply, there are many factors that influence it. First, total supply, which is basically the total amount of coins or tokens that will ever exist for a particular cryptocurrency. Then you have mining or minting. In the case of cryptocurrencies like Bitcoin, for example, new coins are created through mining, a process where powerful computers solve complex mathematical problems. The rate of mining determines the rate at which new coins enter circulation. And also, minting is simply whenever a project will create coins themselves to bring into circulation. So the rate at which they mint can also affect the supply. And lastly, we have tokenomics. Some cryptocurrencies have specific rules governing their supply. For example, certain tokens may be burned or destroyed to reduce the overall supply. Burned simply means the token is deleted from existence. And so while others may have mechanisms to increase or decrease the supply over time, like an inflationary rate of 3 to 10% per year where coins are minted, aka created, and put in supply by the project themselves. Now, it can get way more complicated to where a token has a yearly inflation of 5%, but have that offset where every transaction made with that specific token, then 50% of that value would be burned, mitigating the inflation altogether. So I won't go any deeper than this, but I just want to give an example of how certain projects could actually use both inflation and deflation measures in their tokenomics. And so several factors influence the demand for a cryptocurrency. First off, utility and use cases, where it's the practical applications and usefulness of a cryptocurrency play a significant role in driving demand. If a cryptocurrency has real-world use cases such as enabling fast and low-cost transactions or providing unique functionalities, it tends to attract more demand. Secondly, adoption and acceptance. The wider the adoption and acceptance of cryptocurrency, the higher the demand. When more merchants, businesses, or institutions start accepting a particular cryptocurrency as a means of payment or investment, it increases its utility and attractiveness. And then lastly, market sentiment and speculation. We've gone over this before, but basically investor sentiment, news, and market trends can significantly impact demand. Positive news such as regulatory advancements or partnerships can create a surge in demand, while negative news or market uncertainty can lead to a decrease in demand. Now, when it comes to supply and demand on the charts, you can use this illustration on the screen. Myself tend to lean towards support and resistance, and it's pretty similar. The main difference is that supply and demand stress more on the side of fewer, if not any, touches. It's all about finding the major swings on a specific time frame that haven't been revisited yet. If you want more information on this, you could watch the SMC course that already had made. But ultimately, it comes down to personal preference of how you see the market and what works for you. I believe supply and demand from an investment perspective can be pretty powerful. It just takes a lot of patience to wait to see if the price will reach those support, aka those demand zones, to be able to enter in at and DCA in. I'm going to wrap up this video by marking up zones with Bitcoin on the daily time frame. I'll give it my best effort in drawing supply and demand and how I personally view it. Like I've just stated previously, what you're looking for are the swings in the market, and then you look right to see if the price taps into it. There could be slight discretion at times, depending on how deep in the zone you consider it invalid if the price would come back to retest. But what I'll try and do is find clean, untouched zones for y'all. So let's get started. So as you can see here, I am on the Bitcoin charts on TradingView. If you simply click the button to add a symbol whenever you type in BTC USD. As you can see, there's a bunch of brokers. I personally use Coinbase as my broker, so I have it at that. But what I do know is that a lot of traders will actually use BitGet. That's what I've been hearing. Don't quote me on this. Please make sure to see if BitGet's good, because I think the day trading spreads are really good on this specific broker. So you could check that out and do your own research for that. But I'm going to be sticking to Coinbase, and we're going to be drawing some supply and demand lines. So starting off with, we are looking for the major swings, and we're seeing where price tapped out at. So as you can see here, this was a supply, but then price taps in at there. Like I said, it's discretion, but we're on the daily time frame, so therefore I would not consider this as a supply. What I would do is, though, consider this as a supply, because it was the last time price had moved up before it tanked, and we look right, and there was no touches. And so we could just throw that zone out there and then keep moving on. As you can see, price comes here, and we can consider this as well as a supply. And what I'll do when I'm marking up the supply is I will look for the last candle, the last opposite sided candle. So in this case, since supply is basically resistance, I'll look for the last bullish candle and see where the wick was, and then I'll draw the supply from the bottom of that point to the top of where it reached at. In this case, we have a supply here. Therefore, moving on, we potentially had a supply here, but as you could see, you had multiple taps, and so that wouldn't count for me personally. Moving forward, you could see this will be a potential supply, but you get tapped in this area right here where you have a nice bullish candle into the down move, that would be considered a supply for me as well. So moving on with the next leg, you could see it got tapped in here. This supply that I would draw would be tapped in. And then from this spot here on out, this would be a supply for me. Because as we're looking right here, it was not tapped in yet. And the drawing it is preference, whether you want to draw it at the bottom of that last bullish candle since it's a supply, or all the way at the wicks. In this case, let's just keep it objective in the sense that we'll draw it at the bottom of the bullish candle into the top of however it got. So we'll keep it like that. And then as you can see, now we're starting to look at demand since price is right here. So we're seeing where price could come to for a nice DCA entry in. So this will be the first potential demand, but as you can see, it gets tapped in, so it's not valid anymore. This would be a potential idea, but as you can see here, it is tapped into. It actually goes lower. Apologies there. So I would draw this, and then price actually goes lower from that point. So this area right here would actually be a supply. But it gets tapped in, and this is where discretion comes into play. It's like it gets tapped in at this point. So would you consider that, or in these points, would you consider that as well? Some people say it has to fully go through. And it just depends. You need to stay objective and follow your rules. But I'm just going to leave this here. This would be the lowest demand I see personally. This is a nice clean demand. As you can see, price came all the way down here and then just completely soared up. So there's probably a lot of liquidity here looking to buy more. And then this is also discretionary as well, but a lot of people have like kind of mid demand levels while price is rallying up. You could see there was a huge spike and then a down move, and then price went up again. And so I would consider this bearish candle a demand zone as well. So now we have our demand and our supply zones for Bitcoin. What I'm actually going to do to make this a little bit easier to view and visualize is I'll change the color of all these. So I'll put supply as red, and then I'll put demand as green. And these demand zones specifically is where we would like to DCA in. I personally do not think that Bitcoin is going to get lower than this demand zone. As you can see, this was technically tapped. And so if anything, I could see us potentially being able to DCA in here. But as you can see, prices have been literally bouncing around the supply and demand. Supply, there's a lot of supply here, a lot of sell pressure around this 31,000 level, and there's a lot of demand around this $25,000 level. So we're kind of stuck in this consolidation for a while for Bitcoin. Price went all the way up here. We had some bad news with Coinbase and Binance potentially being sued. But as you could see, this demand zone right here was heavily respected, and it just completely shot back up around the 27,000 mark, and that's where we've been stuck for the last couple weeks. But with that being stated, this will wrap up understanding supply and demand. Feel free to try this out on the chart yourself, and you'll notice a lot of the times that the supply and demand could actually turn into support and resistance, as you can see here. And yeah, play around with it. If you're comfortable with support and resistance, that's completely fine. But I just kind of wanted to give y'all an idea of how to look at it from a different perspective, potentially to DCA in and have really good entries in. But like I've stated before, if you're interested in supply and demand, please feel free to watch Artie's SMC course in that regard. So I'll catch you on the next video. Welcome back to the crypto series, and in this video we'll delve into the fundamental concept of supply and demand and how it influences the cryptocurrency market. Understanding these dynamics. So now we're going to start venturing even deeper into the crypto world and begin to understand how and why things move. Now, nothing is guaranteed in life, but if you could find statistical probabilities that tend to repeat themselves because of certain macroeconomic events, then you will have an immense edge over the majority of people, knowing when to potentially enter and exit the market to capitalize on gains and not get stuck holding your bags. But in order to do this, we must first understand the Bitcoin halving cycle. But first, I'd like to explain why this matters so much. The Bitcoin market cap dominance is currently 48% on TradingView as of June 2023, which I'll be showing you how to find in a video soon. This means of the current 1.1 trillion total market cap in crypto, Bitcoin owns 48% of that. Like we stated before, it was the first of its kind. It was treated as digital gold. It's the only crypto that isn't under regulatory